Silver at $100 by 2026. The supply crisis is here. Have you ever considered what makes an asset truly valuable? Is it rarity, utility, or perhaps the collective belief in its worth? Today, we are witnessing a seismic shift in the precious metals market, one that challenges conventional financial wisdom and forces us to reconsider the very nature of money. Silver, often dismissed as gold's less glamorous sibling, is currently demonstrating a strength that has taken many seasoned analysts by surprise. With prices surging, the question on every investor's mind is no longer if silver will continue to rise, but how high it can truly go. Is the $100 per ounce mark, once a distant dream, now an approaching reality for the year 2026? The current economic landscape is riddled with uncertainty. Persistent inflation continues to erode the purchasing power of fiat currencies globally, prompting a flight to tangible assets. For decades, the global financial system has operated on a foundation of debt and complex derivatives, creating an environment where real physical commodities were often undervalued. We are now facing a potential paradigm shift. The problem, or perhaps the opportunity, lies in a fundamental and growing imbalance. A structural deficit in the physical silver market that has been years in the making. Demand is consistently outpacing supply, a reality that the paper markets are only now beginning to reflect in dramatic fashion. The primary catalyst for this explosive price movement is the convergence of two powerful forces: unprecedented industrial demand and a surge in investment appetite. Silver is not merely a monetary metal. It is a critical component in the technologies shaping our future. From solar panels and electric vehicles to artificial intelligence hardware and advanced electronics, silver's unique conductive properties make it indispensable. The global push toward green energy and technological advancement is not a fleeting trend. It is a long-term structural change that guarantees a voracious and growing industrial need for physical silver for decades to come. This burgeoning industrial consumption is colliding head-on with a constrained supply. Mining output has struggled to keep pace with this escalating demand, hampered by declining ore grades and a lack of significant investment in new projects over the past decade. The result is a multi-year supply deficit that recycling and existing stockpiles cannot adequately fill. Simultaneously, investors, wary of currency debasement and geopolitical instability, are turning to silver as a store of value and a hedge against inflation. This dual demand from both industry and investors creates a perfect storm, squeezing an already tight market. We have now reached a critical tipping point, an event horizon from which the market may not easily return. The physical market in London, the heart of global bullion trading, is showing signs of extreme stress, described by some insiders as being on the brink of seizure. We are observing a rare market condition known as backwardation, where the price for immediate delivery of silver is higher than the price for future delivery. This is a clear and unambiguous signal of a severe physical shortage. Buyers are scrambling for immediate delivery, and the paper contracts that have long dictated prices are being tested by the reality of empty vaults. The immediate impact of this supply squeeze is evident in the dramatic price appreciation we have witnessed. Silver has broken through significant psychological and technical resistance levels, reaching highs not seen in decades. This rally is not merely a speculative frenzy. It is underpinned by a genuine scarcity of the physical metal. The consequences are far-reaching. Industries reliant on silver are facing rising input costs, potentially slowing the very green energy transition that is driving demand. For investors, the landscape has been irrevocably altered. Those holding physical metal have seen substantial gains, while those with short positions have faced catastrophic losses, further fueling the upward price momentum. The aftermath of this repricing event will create a new financial landscape. We can expect sustained volatility as the market seeks a new equilibrium. Major financial institutions are taking note, with analysts from Bank of America, HSBC, and others significantly raising their price forecasts, citing the deepening structural deficits. Forecasts once considered audacious, such as $65 or $75 per ounce, are now seen as conservative milestones on the path to a much higher valuation. The gold-to-silver ratio, long out of historical alignment, is likely to compress dramatically as silver's unique dual-demand profile is more accurately priced by the market. So what is the ultimate takeaway from this extraordinary market event? The enduring lesson is that fundamentals, in the long run, cannot be ignored. For years, the price of silver has been suppressed by a complex system of paper derivatives and leverage trading. However, the unyielding reality of a physical supply deficit is now asserting its dominance. This is not just a story about silver. It is a broader commentary on the distinction between real assets and paper claims. It underscores the importance of owning tangible, finite resources in a world of infinite currency creation. Looking ahead to 2026, the trajectory appears firmly upward. While corrections and periods of consolidation are inevitable in any bull market, the underlying structural drivers remain incredibly strong. The industrial demand is inelastic and growing, while investment demand is likely to accelerate as more participants awaken to the unfolding supply crisis. The path to $100 will not be a straight line, but the destination seems increasingly plausible. Analysts have pointed to this triple-digit figure as a distinct possibility by 2026, driven by the sustained shortage and silver's historical undervaluation relative to gold. This brings us to the broader precious metals complex, where gold has already been charting its own historic path. Gold has surpassed the $4,000 mark, and many major banks like Goldman Sachs and Societe Generale are forecasting it to reach $5,000 or higher by 2026. Gold's rally is driven by many of the same macroeconomic factors: persistent inflation, geopolitical risk, a weakening US dollar, and massive purchases by central banks who are diversifying away from fiat currencies. This strength in gold provides a powerful tailwind for silver. Historically, silver tends to outperform gold during precious metals bull markets, albeit with greater volatility. As gold forges new highs, it attracts widespread attention, and a portion of that investment capital inevitably flows into the much smaller and more volatile silver market, creating a leveraged effect on the price. Given the current market dynamics, with silver's supply-demand fundamentals arguably even more bullish than gold's, the potential for outperformance is significant. The narrative of silver as poor man's gold is being rewritten. It is now a strategic asset with a compelling story of its own. A crucial factor to consider in this forecast is the role of the US dollar. Precious metals are priced in dollars, and as such, they typically share an inverse relationship. A weaker dollar makes metals cheaper for holders of other currencies, boosting demand and driving prices higher. With expectations of future interest rate cuts by the Federal Reserve to manage a slowing economy, the outlook for the dollar is bearish. This monetary easing is likely to provide a sustained tailwind for both gold and silver prices heading into 2026. For those considering how to participate in this market, the method of acquisition is paramount. The fundamental takeaway should be to secure physical ownership. While paper instruments like ETFs offer exposure to price movements, the current crisis is rooted in a shortage of the physical metal itself. Owning allocated physical silver, whether in the form of bullion coins or bars, ensures direct ownership of the asset at the heart of the supply squeeze. This removes counterparty risk and provides true safe haven protection in a turbulent economic environment. It is important to differentiate between investing in bullion and purchasing silver jewelry. While jewelry possesses aesthetic and cultural value, it is not an efficient investment vehicle for raw metal exposure. The price of a jewelry piece includes significant costs for labor, design, and retail markup. To realize a profit on a jewelry purchase based on the metal content alone, the spot price of silver would need to rise to an astronomical level to overcome these initial premiums. Therefore, for pure investment purposes, bullion remains the superior choice. The question of timing is always complex. While the price has already seen a substantial increase, the structural nature of this bull market suggests we are closer to the beginning of a major revaluation than the end. The multi-year supply deficits are not a short-term anomaly. They are the result of long-term trends in both industrial consumption and mining production. Therefore, viewing any significant price dips not as a sign of weakness, but as potential buying opportunities may be a prudent strategy for long-term investors. However, a word of caution is necessary. The silver market is notoriously volatile. The path to higher prices will be punctuated by sharp corrections and periods of doubt. Emotional decision-making is the enemy of successful investing. A disciplined approach, understanding the long-term fundamentals while being prepared for short-term fluctuations, is essential. The potential for a $100 valuation in 2026 is not a guarantee, but a projection based on the powerful convergence of supply, demand, and macroeconomic trends currently at play. The industrial demand narrative deserves deeper exploration. The growth in solar panel production is a key driver, with some projections suggesting that the solar industry alone could account for a massive portion of silver reserves by mid-century. Each panel requires silver, and as the world accelerates its transition to renewable energy, this demand becomes a foundational component of silver's price structure. This is not speculative demand that can vanish overnight. It is a baseline of physical consumption that provides a solid floor for the market. Similarly, the electric vehicle revolution is another pillar of industrial demand. The sophisticated electronics, battery management systems, and charging infrastructure for EVs all rely on silver's superior conductivity. As the automotive industry shifts away from internal combustion engines, its consumption of silver is set to grow exponentially. This, combined with its expanding use in 5G networks, medical devices, and other advanced technologies, paints a picture of a metal deeply woven into the fabric of the modern economy. This robust industrial profile differentiates silver from gold in a crucial way. While gold's value is primarily derived from its monetary and safe haven qualities, silver possesses this monetary aspect in addition to its critical industrial role. During periods of economic growth, industrial demand for silver tends to rise. During times of economic uncertainty, investment demand for silver as a safe haven asset increases. This dual nature provides a powerful, built-in support mechanism for its price across different economic cycles. The investment side of the equation is equally compelling. For years, large financial institutions and traders held substantial short positions in the silver market, effectively betting on lower prices. As the physical reality of the supply deficit became undeniable, these positions became increasingly untenable. The process of these traders being forced to buy back their short positions to cut their losses, known as a short squeeze, has added rocket fuel to the price rally, and this dynamic may still have room to run. Furthermore, we are witnessing a global awakening among retail investors. The accessibility of physical silver, which is significantly cheaper per ounce than gold, allows for broader participation. Individuals are increasingly choosing to store a portion of their wealth in tangible assets they can hold in their own hands, outside of the traditional banking and financial system. This grassroots movement, amplified by social media and a growing distrust in fiat currencies, represents a new and powerful source of demand. Central banks, which have been voracious buyers of gold, have not yet turned their attention to silver in a significant way. However, this could represent a future, untapped source of demand. As they continue to diversify away from the US dollar and other fiat currencies, it is plausible that they may begin to add silver to their reserves, especially given its historical monetary role and its current strategic importance as an industrial commodity. Any move in this direction would have a profound impact on the relatively small silver market. The market structure itself amplifies these fundamental pressures. The amount of physical silver available for investment is surprisingly small compared to the vast sums of capital flowing through global financial markets. A relatively small shift in asset allocation by large institutional funds or even a coordinated movement by retail investors can have an outsized impact on the price. This is why we see such volatility, but it is also why the upside potential is so explosive. Let's reconsider the $100 target for 2026. To reach this level from current prices would require a significant move, but it is not without precedent in the history of commodity markets. Given the confluence of a multi-decade structural supply deficit, exponentially growing industrial demand from green energy and technology, a powerful macroeconomic tailwind from inflation and a weakening dollar, and renewed investor interest, the conditions are certainly in place for such a historic revaluation. The psychological aspect of the market cannot be overlooked. As silver continues to break through previous price ceilings and generates mainstream media attention, it creates a self-reinforcing cycle. Rising prices attract more buyers, which in turn pushes prices higher still. This fear of missing out can become a powerful accelerator in a market with already strained fundamentals. The narrative that silver is undervalued and on the verge of a major breakout is gaining traction and becoming a mainstream conviction. It is also critical to analyze the supply-side response. Can miners ramp up production to meet this demand? The short answer is no, not quickly. Opening new mines is a capital-intensive and time-consuming process that can take a decade or more, fraught with regulatory and environmental hurdles. Furthermore, most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. Therefore, silver production is often dependent on the economics of these other base metals, not just the price of silver itself. This inelasticity of supply means that even with significantly higher prices, we are unlikely to see a flood of new production come online in the short to medium term. This further reinforces the thesis of a sustained deficit for the foreseeable future. The market cannot easily balance itself through increased production, meaning the adjustment must come through a much higher price to either destroy some industrial demand or attract enough investment selling to meet the shortfall. In conclusion, the case for a substantial increase in the price of silver by 2026 is multifaceted and robust. It is not based on a single factor, but on the powerful synergy of several interlocking trends. The relentless and growing demand from vital future-facing industries has created a consumption baseline that is non-negotiable. The persistent failure of mining supply to keep pace has resulted in a deep and structural physical deficit that is now undeniable. Layered on top of this fundamental imbalance is a highly favorable macroeconomic environment. Persistent inflation, a weakening US dollar, and ongoing geopolitical uncertainty are driving a global flight to the safety of hard assets. Gold is leading the charge, but silver, with its stronger fundamental picture and greater leverage, is poised to outperform. The physical market is showing clear signs of a squeeze, with inventories dwindling and premiums for immediate delivery rising. While no forecast is certain and volatility should be expected, the path of least resistance for silver appears to be significantly higher. The journey to $100 per ounce is no longer a fringe prediction, but a plausible outcome discussed by mainstream financial analysts. The ultimate lesson for investors is the enduring power of tangible assets in an intangible world. The great silver revaluation may just be getting started, and it promises to be a defining financial story for years to come.